In the last video, we introduced the capital asset pricing model, or say the CAPM model. It helps us to estimate the required rate of return of a stock based on its beta. It provided a so-called linear relationship between the return and the beta of a stock. We can also try to interpret this linear relationship by a straight line, and this straight line is called the security market line. The security market line apparently is a straight line, and on the x-axis we have different beta values, and on the y-axis we have the required rate of return. Remember again, the CAPM model says required rate of return is the risk-free rate plus beta multiplied by the market risk premium. Higher beta, higher required rate of return. Lower beta, lower required rate of return. If we look at some important points on this straight line, we see that when beta is 0, that's a risk-free investment. And for risk-free investment, we will have the risk-free return. So here we have the risk-free return, and this is also where this security market line intersect with the y-axis. When beta is 1, we have an investment or say asset that has the same level of risk as the overall stock market. So that would be like a market portfolio. Or say you invest in a portfolio that's as diversified as the whole stock market. And when you have that, beta is 1, you are here, and the return is actually the market return. And then for any stock in the market, its required rate of return can be found on this line according to the beta of the stock. For example, we have General Electric, and its beta is 1.2, so General Electric will be here, and the return of General Electric will be around here, higher than the market return because we have a little bit higher beta, higher than 1 here. So by looking at this line, you can also try to answer these questions. First of all, what is the slope of this line? The slope of this line is the market risk premium. Remember, required rate of return equals to the risk-free rate, the intercept, plus beta multiplied by the market risk premium. So beta, different beta level here, and market risk premium is the slope. What is the beta of the market portfolio? Beta of the market portfolio is 1. The investors will require the market return for the market portfolio. What is the beta of the risk-free asset? If it's risk-free, then beta will be 0, and you would earn the risk-free return here. Now, we can try to use some examples to explain the calculation under the CAPM model. If we are looking at AT&T stock, low beta of 0.55, and risk-free rate is 3%, market return is 8%, then what is the required rate of return for AT&T stock? We're following the CAPM model, risk-free rate plus beta multiplied by the market risk premium. You notice here the market risk premium 8% minus the 3% to give us the premium. Again, premium literally means the extra part. If the market delivers a return of 8%, the extra part is the 5% here. Required rate of return for AT&T according to this model is about 5.75%, which is lower than the 8% market return. It is lower than the market return because its risk is lower than the market risk, because the beta is lower than 1. Another example here is if we are looking at a stock that has 1.2 beta, risk-free rate 4.5%, market return is 11%. Based on these two numbers, you can figure out the market risk premium. And in this question, because you are the CFO, maybe you know a little bit more or better than what the market or other investors know about your company. So according to your estimation, you think the company actually can deliver a 30.5% return. Then, is this company's stock undervalued or overvalued? To answer that question, let's start by using the CAPM model to estimate the required rate of return. 4.5% risk-free rate, 1.2 beta, and market risk premium is the difference between the market rate and the risk-free rate. So according to the CAPM model, the required rate of return is about 12.3%. Or say investors would require a 12% return for bearing the relatively higher risk of the stock. Now this number is actually lower than what you think as a CFO your company can deliver. So that means this company actually can make a higher return, higher than what's required by the markets. So in that sense, the current price of the stock is undervalued. And that would give it room to appreciate in the near future to realize a 13.5% return, because otherwise, if your stock is already priced at, well, it should be, then your stock should only deliver a 12.3% return. So the fact that the expected return here is higher than the required rate of return, that's giving you the idea that at this point the stock is undervalued, and in the future the price will rise more to realize this 13.5% return. So we'll talk about using the CAPM model to estimate the required rate of return. And to use the CAPM model, we need to plug in the beta. How do we get beta? You can get beta in mainly two different ways. You can try to compute beta using the return data from this company's stock and also the return for the market portfolio, or say, let's say the S&P 500 index return. Well, this approach is actually not required for the intro level class here. If you're a finance major in your financial management class, you definitely will try to get the historical return data for both this company and the market and run a regression and get the so-called beta coefficient as the beta of the stock's return. Anyway, not really required for this class though. You can also try to find beta for a stock in different resources. For example, I showed you the beta for Facebook and Verizon. They were from the website Yahoo Finance. You can also go to different websites, go to cnbc.com, find the beta of the company. Value line is another useful source, but it's not really free. In the college, we also have the Bloomberg terminal. Maybe you have seen it in Starlab. So Bloomberg actually give you access to all kinds of financial information, so you can easily find beta of the stock from the Bloomberg terminal. So far we've talked about beta for one stock, but what if we have a portfolio? A portfolio beta is just the weighted average of all the betas from all the stocks in this portfolio. So as you see in this equation, this is the portfolio beta. Beta 1, beta 2, beta 3, these are the beta of different stocks in the portfolio. Now to calculate the weighted average, we use the weight that is about the portion of one stock in the whole portfolio. So if you look at this example here, we have three stocks in this portfolio. $100,000 in stock A, $150,000 in stock B, and $250,000 in stock C. The total portfolio value is $500,000. And then if you think about stock A, $100,000 out of the $500,000, that will be a 20%. And stock B, 150 out of 500, that will be a 30%. And for stock C, 250 out of 500, that will be a 50%. So then, to calculate beta of the portfolio, W1 multiplied by beta 1, that's from stock A. W2 multiplied by beta 2, stock B. W3 multiplied by beta 3, that's from stock C. And then we just sum them up, and again, this is a process of calculating a weighted average. So the beta of the portfolio according to this calculation is 0.79. Then to estimate the expected return for the portfolio, we can use the same CAPM model, just like what we did for one stock. So the beta of the portfolio is 0.79 from the calculation above. Beta multiplied by the market risk premium added to the 3% risk-free rate, that will give us a required rate of return of 6.95%. So that is the required rate of return for the portfolio based on the portfolio beta we just calculated. We have another practice question here. If we have a portfolio that has 20% invested in Boeing, and Boeing has a beta of 1.04, and 40% invested in HP, and HP, the computer company, has a beta of 1.54, and then 40% invested in McDonald's that has a low beta of 0.34. How much market risk does this portfolio have? This is to ask what is the beta for the portfolio. So the beta of the portfolio is again the weighted average. So 20% in Boeing multiplied by Boeing's beta, 40% in HP multiplied by HP's beta, and 40% in McDonald's multiplied by McDonald's beta. The last step is to sum all of them up for the whole portfolio, and the portfolio beta is 0.96. And that beta is a good measure about the market risk. The last topic in Chapter 10 that we want to talk about is the so-called capital market efficiency. So if we think about an efficient stock market or efficient capital market, what is an efficient market like? An efficient market would have many buyers and sellers very active in the market. There should be no high barriers to enter the market. So if someone wants to get into the stock market and start investing, there should be no high barriers. And also, if someone wants to sell their stocks, there also should be no high barriers for them to sell their stocks and get out. Another very important requirement for an efficient market is the free and available information. Information should be free and available and should be transferred very fast to all the market participants. And the trading or transaction costs should also be very low. So then if you look at our stock market, the question is our stock market really efficient? And if yes, so what? Or say, what is the implication of the stock market efficiency? People look at the market efficiency idea and they try to answer the question about whether the stock market is efficient in the weak form or semi-strong form or even the strong form. If the market is efficient in the weak form, the current prices should reflect all the information derived from trading. That means all the historical price or historical information should all already be priced in or say be reflected in the current stock price. That also means that the future prices cannot be predicted by analyzing the prices from the past. You may be aware that in investment analysis, there is this idea called technical analysis. So basically, people look at the price chart from the past and try to use those charts to analyze and predict the future prices. If the market is weak form efficient, then technical analysis would not provide any benefit because all the historical prices should have already been reflected in the current price. If the market is not just weak form efficient but also semi-form efficient, that means the price already reflects all available public information. including information such as the financial statement, news, and analyst opinions. In that case, the share prices will adjust to publicly available new information very fast. Then you can hardly make money or say make excess return by trading on those publicly available new information. Then maybe the only way you can make excess return is to have access to information that's not so publicly available. Maybe you need some inside information. However, if the market is efficient in the strong form, stock prices would reflect all information including public and private, so then no one can earn excess returns. Whether the market, such as the US stock market, is really efficient in any form, that takes a lot of research and it's still under a lot of debates. An efficient market would require rational investors. However, a lot of times people may behave in irrational ways. So sometimes we can be overconfident, sometimes we can be over pessimistic. All these actually can make our opinions biased and make us make irrational decisions. So in the behavior finance study, researchers try to look at how people's behavior, especially the irrational behavior, affect the decision-making process in the stock market and affect the overall stock market efficiency. As the end note of this chapter, we want to talk about the implication of this risk-return relationship for financial managers. In a corporation, the financial managers need to understand the risk and return relationship. In addition to the CAPM model, managers can also try to use the constant growth model to estimate the required rate of return. You can see this again later in chapter 11. Here, let's just look at this equation. It is based on the constant growth model that we talk about in chapter 8. Remember from chapter 8, we talk about the constant growth model. Price is dividend in the next period divided by I minus G, while I is the required rate of return for the stockholders, and G is the growth rate, the constant growth rate of dividends. Now, if we rearrange this formula, assume that we know P, the price, which we can observe from the stock markets, then I, the required rate of return, actually is D1 divided by P and then plus G. And also back in chapter 8, we mentioned this return can be considered as a total of the two parts, where D divided by P is what we call as the dividend yield, and the dividend growth rate can also be considered as the capital gain yield for a stock with constant dividend growth. Again, this formula is for financial managers who is familiar with the growth rate and dividend payment pattern inside the company and try to use this to estimate the required rate of return if the company is experiencing some stable growth. Again, we'll talk a little bit more about this in chapter 11. So as a summary of chapter 10, we have tried to understand the concept of risk premium and also the market risk premium. And then based on our understanding of the risk premium, we look at the CAPM model and use CAPM model and the beta to estimate the required rate of return. The CAPM model can also be interpreted as a straight line, so we look at the security market line. You should be able to describe the whole security market line, including the intercept, the slope, what's on the x-axis, and what's on the y-axis. In the last part of chapter 10, we briefly talk about the market efficiency and the different levels of market efficiency.